Welcome back to Everything Money. We're certainly glad you joined us. Paul, we have patrons all over the world. They're great supporters of ours, and we're supporting them with the software we'll show you in this video. Today, we're talking about how and when, why, and what you should be doing if this market crashes or corrects. We get this question all the time. In our comments, our patrons, our followers, they ask, how can I prepare? How can I be ready for a correction or crash? I know a lot of YouTubers use, sort of the clickbaity articles like this is all falling down. What should we do? But you like to take a more balanced approach, Paul. Is like, what in your wisdom of investing you've been doing for 20 years, how can normal people like myself become ready for some sort of correction, have my money ready? It's a kind of a deep story, somewhat scary, but the point of having you is to fondle us and caress us during a time. And so tell us how you're going to be doing that.
So I'm going to talk about three different ways in which people buy stocks. ETFs, straight up stock purchases, I'll put stocks with an X, and then also puts, options. Okay, guys, I want everybody to understand, I deal with the same frustration when talking about, I remember a year and a half ago before the COVID crash, telling my brother and Mo, and my friend Michael, my biggest concern is how do I get into stocks when the prices are finally at their levels? Because I do believe in the pendulum swing. I believe that, even before COVID and right now especially, stocks are massively overpriced. So when the pendulum swings, I don't think stocks will go to exactly what they're worth. They will usually go below what they're worth. And that'll be a combination of price falling and valuations getting better, right? Fundamentals getting better. Now, the first one, ETFs. Guys, for the vast majority of everyone out there, you should be buying low-cost index funds or ETFs that track the market. You should be doing this on a monthly basis no matter where stocks are at. It's called dollar cost averaging. When you have stocks, this is the value, this is where stocks go. So if you're buying an ETF, you're buying everywhere along the line here. Sometimes you're overpaying and sometimes you're underpaying. Don't change what you're doing.
Yep.
As stocks fall, all you should care about is, I am 15, 20, 30, 40 years away from retirement. All I care about is over long periods of time, I will pay about what the stock market's worth. If you try to guess or change your method along the way, you will only cost yourself money. There's a saying where, in the last 30 years, the markets have done X, and if you miss the top 20 days of those X, you made pretty much no money. I get it. Now, you also could have missed the top 20 worst days, but the whole idea is don't try to time the market. Your job when you're dollar cost averaging, which should be the case for 99% of people watching for the majority of their money, is to buy every single month, in, month out. Don't think about it, just do it. And over long periods of time, you will end up with a lot more money, right?
Yep.
This makes perfect sense. Every smart investor in the world tells that. Every great value investor talks about it. Buy low-cost index funds and ETFs, track the market. 82% of mutual funds do not beat the market. So that means if you buy a low-cost index fund that doesn't even think, just matches the S&P, you will basically match the market with a small fee of 0.05 or 0.0 or 0.1%. It'll cost you nothing. Just do it. Be smart. Now, with that said, if you're like me and like to buy individual stocks with either all or a portion of your money, this is where it becomes harder. Guys, the important part here is to buy stocks at a value that makes sense. You will never, ever, ever buy at the exact bottom, and you will never, ever, ever consistently sell at the top. That is just, the whole buy low, sell high is the most overused and overabused statement. It makes it seem like it's very easy to just, oh, stocks are here, why don't you just buy here? Yeah, guess what? When the chart looks like this, it's easy to in retrospect to say, oh, I could have bought it here. No, you couldn't have. You would not have bought it here. The example I always give is Amazon in 2000 went from $113 down to $6. If anyone here even tries to tell me that they were a buyer at $6, then you're just a liar. And if you did do it, I want to see all your other 100 companies you've owned since then because you didn't buy them at the bottom. It would have been a fluke luck if you bought it. One time in my entire 20-some years of investing, did I get lucky where I bought a stock literally the day before I bought Cisco one day. That next day, it went up 24% or something like that on some earning. Complete dumb luck. It doesn't happen. So with stocks, my recommendation is If you want to have a portfolio over 20 or 30 stocks, when you're ready to build a position in the company, you start with an initial purchase and you dollar cost average for the next X amount of months. How you pick that, I don't know, and I don't care. Just pick something that makes you feel comfortable. So let's say, for example, you're going to own 20 stocks. It's 5% per stock. Maybe you put 1% in for the next 5 months on that stock, right? It makes sense. You're just going to buy at the first of the month, 1% every single month for 5 months, dollar cost average. Maybe you do 0.5% for 10 months. The point is, when it's at a price that you can't do without, just start buying it, do an initial purchase, and pick whatever strategy you have and stick to it. Put all 5% in, it doesn't matter, but just be ready for drops in pricing, because when stocks do fall, even good valued stocks might fall with it.
So the question we get the most time is, should we wait, Paul? We've done market crash videos that's saying the estimated return in the next 10 years is going to be very, very bad. We got this question in a live stream is, should I just, with the expectations seeming so low? No.
Here's why. If you're doing the ETF strategy of saving for retirement, you never know what's going to happen. I've been saying for 5 years now, stocks are overpriced, and I've been right for 5 years. But the results have said I'm wrong, right?
Yes.
Don't try to guess. Buy the ETFs every single month. When it comes to individual stocks, if you find glaring stocks right now that are selling for good prices, which, by the way, I think there are ones out there. I'm a buyer of Intel, I'm a buyer of Walgreens, and I'm a buyer of Alibaba right now, right? Mm-hmm. I'm still buying even though the market is at really all-time highs. As long as you find good value stocks that have good propositions for the future and you can buy them at no-brainer prices, just being patient will work out for you.
Mo,
don't try to time the market.
Mo, how can people in the Business Nation who are trading stocks get ready for a large correction? What are the signs you see? I mean, give us your thoughts.
So it's learning how to short. Shorting stocks from a chart perspective is a very good thing to know. And I've done shorting seminars on this. If you join the Business Nation, you can watch them. They're maybe an hour long. To me, what shorting is on a chart is you literally look at the chart and flip it upside down, and there's a short. It's the same thing as going
really?
Yeah. I mean, I actually did it during one of the seminars. I was like, let me try to do this. So I took a screenshot, flipped it upside down, and I was like, look at that. It's exactly the same. All you have to do is just understand, because you're just going in the opposite direction. Let's see. Let me move this thing out of the way. Okay. So your market's going up, 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 and then all of a sudden one day you just start to crash. So what we're doing here is coming from the top, you are just coming down through the sweet spot. It's the same thing as going up through the sweet spot in the reverse direction. You're finding engulfing candlesticks. You're going to want to have good selling volume. And when you get to the bottom here and you're just going sideways, it's the same thing as being overbought and the stock price keeps going up. When you're oversold, just let it go sideways. The stock price just keeps gradually coming down for you, and it's the same. Now, when do you sell, or when do you take profits on a position? Right when you pop into the sweet spot going in the positive direction. So just like when you're selling, coming down, and taking your profits, it's just the same thing. You're buying back your shares to cover. So the way that I teach this in the shorting seminars, it's so simple. You're literally reversing the charts, but you do want to know how to short because it's so much easier to make money going. Stocks fall a lot faster than they go up. And when you have the entire market falling on you, you want to know how to short on a chart from a long-term perspective, day trading perspective, and a swing trading perspective.
Paul, for folks maybe a little older in life, upwards of 55, 60, maybe moving toward retirement, I mean, what is the strategy for what you think might be an upcoming correction or crash? I mean,
well, you have to always allocate your money based on where you are in your life. If you're coming very close to retirement, you should meet with somebody who can show you, as much as I hate financial planners, you shouldn't have the vast, vast majority of your wealth in stocks. You should be more cautious, especially at these levels. But over time, you should have been pulling back your stock allocation anyhow, right? Now, one thing you can do, if you're older and have a lot of shares of a company, you can do what's called selling puts. Now, this is another way in which the dollar cost average and earn some income along the way. So what does this mean? Let's say a stock is selling at $100 and you bought it, but you want to buy it also at lower prices. You can sell a put at $80. What this means is you're selling somebody the right at a future date to put the shares in your hand at $80. So maybe they pay you $1 for a month from now. They're going to pay you $1 for one share that if the stock falls to $80, they're going to force you to buy it at $80. You still keep the dollar, so you basically paid $79, but you got the stock at a price you wanted. Now, what's the catch? The catch is that the stock went to $70 and not $80. You're still forced to buy it from them at $80. You keep the dollar, So you basically bought it for 79, but the stock is selling at 70. Now you might sit there and say, well, that sucks. Well, that's the great news about being a value investor. If you would have bought it at 80 no matter what, because you liked it at 80, you still would have absorbed the $10 loss, except now you get $1 to wait. Now, what if the stock doesn't hit 80 bucks? Let's say it goes to 90 in that 1 month period. You keep the buck. You don't get the stocks at 80 bucks, but you get to keep the $1 of income and you can write it again over and over. This is a strategy that I use to buy stocks I want. Recently with Alibaba and Intel, I made an initial purchase and then I sold puts along the way. And every month I'll probably also purchase more, but also sell more and more puts at lower prices to generate income while I wait for the stock to fall. This is another strategy to use if you have more shares. Now the catch is you have to have 100 shares at a time.
Well, you also have to know what you want to pay. I mean, find
Correct.
a fair value and know what you want to pay in the future for it.
Correct. And that's why we have our software that you can go to everythingmoney.com and sign up for 80 cents a day and watch our videos to learn what you need to pay for a stock and use our stock analyzer tool where you enter in your assumptions and it'll tell you exactly what you need to pay for the stock based on those assumptions, right? So if you understand all these things, you can use all these tools to generate income and generate higher returns on your money. I always tell people, my goal is just to match the market on overall stock picking, which I will beat over long periods of time, but I will also then use options to generate higher returns along the way. It's just a great way to generate income and buy stocks you want, the prices you want, and sell stocks you want at the prices you want.
You know, a friend of mine, Paul, this weekend, I had a conversation, and to bring it all home is he actually said, unfortunately, that our style of investing, value investing, waiting for things to fall, it couples with a lot of people financially suffering.
Well, my ex-girlfriend used to say this, like, Paul, doesn't it suck, though, that in order for you to make a lot of money, a lot of people, to which I say, that does suck, but I don't feel bad when I tell people that a stock is overpriced. I got a message on Instagram this weekend, and I'm going to keep it because this person told me I didn't understand Tesla. I didn't understand the future potential, that Kathy Wood runs a hedge fund, which she does not. She runs an ETF, and I don't. And he literally wrote, last time I checked, she has a hedge fund and you don't, as if that makes her right. No offense, that person probably needs to lose a lot of money to learn the right way of investing. We all learn better when we make mistakes financially, right? It all ends up being better over the long run when we make our mistakes. Unfortunately, for most people, they have to have a temporary loss in net worth. My argument would be their net worth shouldn't be this high anyhow. The stocks should have never gotten this high anyhow. And if you're a long-term outlook on things, then it'll all work itself out in the long run.
Yeah.
If you're 30 and you lose 20%, 30% of your net worth, who cares? You're 30. You've got till 65, 70 before to worry about it. That's when you should be worrying about it. For the time being, yeah, I get that people have to lose their money. But we have to learn our lessons. We learned so many lessons from 2000 because of the dot-com crash. We learned so many lessons from the credit crisis. We learned, well, I'd argue we haven't learned those lessons because we're still repeating them, but it might be even worse. But that's what recessions and down markets are good for the economy in the long run. It's kind of like a reset. Let's get back to fundamentals. Let's get back to good times. Let's get back to building businesses for the real reason, which is cash flow and profit.
If you like the way all this sounds, you can join our Patreon below. We're moving off Patreon here in the next couple months, so you go to everythingmoney.com. But in general, you can join our community, join the Discord chat, and talk with people all over the world that have this sort of mindset. It's a lonely path, Paul. I mean, if you go and talk to normal people, Mo, there's not.
Well, if you read the book, Richer, Wiser, Happier, there's the chapter on that Sir Thomas Templeton.
Yeah.
He said it's just a
John
very
Templeton,
lonely. John Templeton's a lonely road.
Yeah, it's lonely thinking this way, and you sometimes look wrong for a while, Paul. But we'll look right at one point, and we'll see you on the live stream when we do. So that's our take. Tickle a thumbs up on the way out. We appreciate you watching. We'll see you next video.